unfortunately. One of the largest companies in Germany, Volkswagen, is declaring an economic emergency. And Volkswagen is to Germany what General Motors used to be to the United States. And there was a saying that when General Motors sneezed, the United States caught a cold. So if things were bad for General Motors, it was bad for the United States. Likewise, I think when things are bad for Volkswagen, things are bad for Germany. So let's dig into this article. And more importantly, what it means to the United States, because I've shared many times on my channel this soft branding that we're all hoping to get and avoid a recession, avoiding a major drop in the United States. That typically doesn't happen when you need to slow inflation from the levels we were at. So this is definitely a leaf in our pool of tea leaves that we're looking at to try to see what's going to happen. Okay, the article's from Reuters, and the article's titled, Volkswagen Labor Chief Sounds Alarm on Mass Layoffs and 3 German Plant Closures. It says Volkswagen plans to shut down at least 3 factories in Germany, lay off tens of thousands of staff, and shrink its remaining plants in Europe's biggest economy as it plots a deeper than expected overhaul. Okay, so is this just that Volkswagen is going through a tough time, or is this more country specific? And just like I said, if GM sneezes, the United States back in the day would have caught a cold. If Germany sneezes, Europe's going to catch a cold, and that could lead to contagion in the United States as well. So let's see what's happening with Volkswagen. And the article goes on to say, this is the plan of Germany's largest industrial group to start the sell-off in its home country of Germany. And they didn't specify which countries would be affected of the over 300,000 staff members that could be laid off. That's an enormous number of people. And so what's causing this? The article goes on to say the company faces severe pressure from high energy and labor costs, stiff Asian competition, and weakening demand in Europe and China, and a slower than expected transition to electric vehicles. Okay, so let's double click on this China issue. And we can see Reuters also has this article. The title of it is China, Price Cuts and Costs, the fuel driving the Volkswagen crisis. Okay, so that article goes on to say that there's increased there's really 2 things that are driving this challenge for Volkswagen, driving this challenge for Germany, and potentially could trickle into the United States. And those 2 things causing challenges for Volkswagen is increased competition from China at home, but also the Chinese market is a more difficult market for Volkswagen selling cars. And so what does this mean? It's not good news for Germany. It's not good news for Europe. It's definitely not good news for Volkswagen. And what does it mean to the United States? Well, that's why I double-clicked on that article and looked into what is causing this challenge for Volkswagen, and the fact that they're seeing more competition in their home country, and the China market itself is becoming difficult. I think we're going to see that here in the United States as well. This is not a political channel, but right now we have higher tariffs on China than we ever have had in the past, and I think that that's likely going to increase based on the results of the presidential election. Now, this, again, it's not a political statement. Trump put those tariffs in place, and you know what? Biden didn't take them away, right? So both parties are involved in tariffs, and people can argue whether tariffs are a good thing or a bad thing. I can tell you most economists would say the fewer tariffs we have in place, the better. We do need to use tariffs strategically when there's people that are abusing the system. Most economists would say that broad tariffs are not a good thing. Now, we're about to see an experiment unfold. President-elect Trump has said that he's going to increase those tariffs. again, a lot of the PhDs, a lot of the economists would say that's going to be a bad thing. But you know what? They might be wrong. We don't know. I don't know. You know, I'm trained, I'm educated on traditional economic models, and so my gut is telling me it's not going to be a good thing. But you know, we're about to find out. So we're headed that way. So again, let's get to the broader issue. Is there anything that we need to worry about? Well, there's times when there's a lot of factors in favor of an economy and a lot of factors in favor of the stock market. There's times when there's a lot of factors in favor, and then there's also times when there's fewer factors in favor. We're continuing to see what we've seen over the last 2-3 years, the last decade. You know, there's times where it's more likely that that's going to happen. There's times that there's less. Now, before I jump in, I don't have a crystal ball, and anybody that tells you they have a crystal ball is lying to you, but the market is at an all-time high. Warren Buffett has what he calls, or what those of us that follow him call the Warren Buffett indicator. And it looks at what's the total value of the stock market divided by the country's gross domestic product. So what's the value of all the companies that are producing things? And what's the value of the economy where these companies are producing those goods and services? And right now, that is not one standard deviation above, but it's 2. So it's super high. The Buffett indicator would tell us, let's be cautious. We also need to look at, you know, what's the likelihood if the stock market does keep going up, how much more upside is there? And how much more downside is there potentially? Again, I don't have a crystal ball. My joke always with my clients was, you know, my crystal ball is cracked. I do have a crystal ball, but it's cracked. But if we look at what's the upside potential for the stock market and what's the downside potential. Now, we've just finished, as I record this, a 12-month period where the stock market, the S&P 500, is up over 30%. That's a life-changing move. And for people that had a healthy exposure to the stock market, that has given them several years' worth of gains. Now, my caution, again, I don't have a crystal ball, but my caution is during periods like that, it's easy to get your asset allocation more aggressive than what might be right for you. I don't know your situation. This is not financial advice, but we've just had a really nice period with a really nice gain in place. It would not be unusual for people to have more asset allocation to equities than what their long-term plan probably says that they should. And so I encourage you to visit with a financial advisor, preferably somebody that has a fiduciary duty to you 100% of the time. Get with a financial advisor and make sure that your asset allocation is right for you, because it's a lot easier to ratchet down your asset allocation when what you're selling is at an all-time high versus if the stock market crashes. Then it's really hard to make that adjustment. So I encourage you to do that, and I also encourage you to watch this video here where I talk about what are the average expenses for retirees in the United States. Videos, average income for retirees in the United States.